Today is brought to you by the letters D, C, and A. Hey everybody, this is Spooky Revenge. We're back with another episode of the 5-year $500 Rags to Riches series episode words. Let me get my face down here. So today I'm going to talk about DCA a little bit because there's a right way to do it and a wrong way to do it. DCA stands for dollar cost average, and that can apply in the upward direction and the downward direction as well. So for those who are not familiar with the concept, this tends to be a little bit revolutionary as well as, you know, the first day of your last day in the market. So you got to be very careful about how and when you do it. So to dollar cost average, all it means is that when you have a position and then you add more shares or more dollars, more value to that position, that will adjust your cost basis or your average cost per share or per contract if you're trading options. And we typically do this as a means to build down our average and then reduce our risk exposure. So if we're being responsible, if we buy one small position up high, you know, in the anticipation that it should continue to go up, if it doesn't, we may make the decision for a longer term trade to wait till the price falls down to an appropriate level, finds support, starts to push back up, and then we add another piece to reduce the average. So let's just draw an example here. I'll use Johnson & Johnson just for fun. Let me go way up here so it's not getting in the way. So say I bought my first share here. Okay, price is coming in, bippity boppity boop, bought my share, price fell down here, right? Started to find a support, started to push up. I can choose whether or not I want to add another share here. So when I buy this share, okay, my average is going to be up here, right? Because that's the average price that I paid per share. So if I bought 5 shares, it would be $206.25 per share across 5 shares, which is $1,030 and $1,031.25. Hooray for math. But if I buy 5 more shares down here, it's not going to be directly in the middle because these shares cost less. So it'll be slightly above the midpoint if I buy the same. But if I add the same number of dollars, it'll be exactly in half, right? And of course, you can't do that specifically without fractional shares, but just as a rough guesstimate, it should be somewhere in the middle. So that's where the price should end up. So basically what we're doing is we're doubling the amount of shares in this case, or the number of dollars, depending on how we approach it. And that's acquiring more shares and then pushing the average per share down to here. And then when the price comes back up here, what we can do is we can offload some of those shares, right? And that would reduce the risk exposure that we have while keeping that nice low average. And all that does, in essence, is it takes all the buying and the selling and all that good stuff, and it takes this first buy, and it moves it down here. That's all we're doing. So we're taking our average, which was up here, we're moving it down to here. That's the entire process. That's the end goal, right? The problem with this is, what do we do when we place a buy here and then place a buy here and then the price keeps going down here, right? That forces us to commit even more money at that point. And that's where it becomes dangerous, because then if you do these too close together, or if you don't find supports and strong levels and the price just doesn't reverse, or even if the setup is perfect and then they announce some sort of horrible catalyst and you just get stuck in that position, what you've done is increased your risk exposure and your drawdown. Right, your drawdown value is going to be increased. So we have a choice to make at that point. We can either stop out, accept the loss, take it on the chin, or if we see the process repeat, we see another support, another reversal in trend, another good opportunity that has, you know, confirmation things, then we can continue to add. And, you know, you'll have to commit more at that point, and that's, again, where a lot of people tend to get hurt. Because what you don't want to do is put all your buys like right here. And then the price just, you know, it might shoot all the way down here before it starts to come back up. So rather than placing maybe one buy here, maybe one buy here on the way up, and then keeping this one off to the side in case you need it, what a lot of people tend to do is they add here, add here, add here. Every green candle they can find, they'll buy, right? And sometimes they don't even wait for green candles. So, you know, it's just as important to have a mechanical system in place when you're doing this stuff. So if we look at NIO, looking at the 1 hour chart, that's what I did, right? And this might look horrific and stuff because I'm on the 1 hour chart, so it's pretty close. But sorry, I just had to check the time. In reality, what I've done here is I placed one order here, right, at the support level with Mr. Porter here, right? That's all we did. We just grabbed the support level. It pushed up above almost above 950, and then it sold off really hard because it broke this resistance level but it didn't have the retest and confirmation we were looking for. So that is outcome number 1 of, 3 potential outcomes at all times. So all we did here is place an initial buy, right? And he chose, I believe, to stop his position out at a small loss, right? Or I think he locked some profit too on the way up, but I think he chose to stop it once it lost like $7, I think $8. Whereas I preferred a DCA, or dollar cost average down, because it's a leap. I got plenty of time on it, and I can always manage my positions. And this is part of what happens with like special dividend positions, for example. If you buy, hold through XDiv, the share price is adjusted down, and then you kind of have to figure out whether or not you want to realize a loss, wait for it to come back, or potentially recover it if it sells off even harder, or just sell it a reasonable loss if it doesn't. So either way, we're covered because we can use it for tax advantages, or we can, we can manage things, right? That's our job. It's not just to guess and hope we're right. It's to manage the position. So part of this is understanding that you have that tool in your toolbox, and you can use it when it's appropriate. You don't want to use a hammer to take a tree down, right? You got to use the appropriate tool for the job. But in the case of NIO, if I look out here at the weekly chart, it's really not that far down, right? So I bought this on December 15th at 11:04 a.m. Eastern for $40 contract. Okay, so the premium is 40 cents times $100. That's $40 for the contract. I bought 2 more this morning when this volume came in at support at $25 each. I got filled kind of high because I didn't want to miss it. So the bid-ask spread was like 22 to 25, and I just filled at 25 to get it. So if I right-click over here, you can see that, right? $40. I'm sorry, December 13th I bought it. I lied, but I got the 11:04 part right. So altogether, I've got $90 committed to this position, and I still have a little bit more if I want to, because this is a leap and I'm okay using a larger position for this. Now, if I was day trading and my max allocation for day trades was $50 for the day, and I was sitting at $45, I would immediately just set a stop loss because I don't want it to lose this low again. However, this is a leap, and my plan, once it gets to my break even, which we're about 4 cents off on the contract, is to reduce this by at least 1 contract to get some of that money back freed up and move that average, right? Here's the average that I paid, down, right? It's the same position size. If I reduce it, I put a buy up here, a buy down here, price came down here, and then I averaged down, right? I bought another one that lowered my average to right between them. And then when the price comes back up, I'm taking this anchor buy out of the mix, and that just moves my first buy down to here. That's the trick. That's the whole process. Now, the challenge and the art and the finesse, of course, is doing that appropriately. So what I've done here is I waited for certain criteria to be met. The first one was volume. I needed to see this massive volume of 11 million shares, and it happened this morning right into market open. So if you look at yesterday, for example, there's 12 million shares. So it's increasing up until this morning, obviously, but it cut off. But the last few days, we've had some pretty significant volume. If you look at this right here, right, in comparison to back here, this is increasing volume, which tells me there's strength at this area, and I plan to use it, right? And another indication that we have, if I could pull it up here, I'm willing to bet that there's RSI divergence on this. I haven't actually tried this. Yeah, there's RSI divergence, and we're now over the 50 level. So that's another indication that I can use that the trend strength is weakening, and that's an opportunity for a reversal. And when it breaks over 50 with some impact, some significance, that's a pretty good indication that the bulls are stepping in, and they've not only slowed the bears down, but they're ready to take over, right? It's not a guarantee, but it is an opportunity for me to place a second buy, reduce the cost basis, and then set a break even just above my average, just like I do on the other shares, to recover that position and lower that average. Now, the drawback here, besides the risk, right, is that instead of having a $40 position on one contract, if I reduce this here, I'll have a $30 contract, and that's okay, right? Because my average is then $30, so I am a-okay with that, opportunity cost, right? Because we're sacrificing some potential profit in exchange for a higher quality setup and a lower average. So just kind of wanted to walk you guys through that, because this is something that we, it tends to blow people's minds once they figure out that you can break up your buys and build a position down. We used to use the 25, 25, 50 rule. 5, 10, 15, 20, 25, 25, 10, 20, 30, 40, for example. The reason we stopped putting those alerts out specifically in the community is because we You know, in order to do that effectively, you kind of have to have some analysis skill, or at least the patience and discipline. You got to have your psychology on lock in order to wait for those major support levels to be hit, tested, and confirmed off of. And we saw that a lot of members just couldn't quite get there. So, I have to end this stream right now. Thank you all. I will upload this episode and catch you later. Thank you. Bye.